a realtor and talk show host all in one. Get tips, advice, and valuable lessons from the successful and rewarded Sotheby's Vice President, Jennifer Hammond. With more than 20 years of real estate experience, she'll make it look easy. Here is Jennifer Hammond.
Hello. I'm Jennifer Hammond, and I'm here with Linda DeMarlar. She is our tax expert. She's with Tax Masters in Rockville, Maryland. We'll make sure you have all the information at the end of the video. But today we're going to talk about really interesting. Real estate's always important that you understand the tax strategy that you want to apply to your real estate. So often people ask, shall I buy a rental, a property that I rent out, or should I buy a second home? Now again, the second home might be the one that you want to go to ski or at the beach. So what are the tax differences and advantages of buying a rental property versus buying a second home?
Okay, well, first of all, if you're my client, which you are, and you come to see me, I'm going to tell you, you can do both. You don't have to choose. You can buy one property, which you can use as your second home, and we'll figure out when are the best dates and times for you to do so. And you can also rent it out. So you don't have to choose. Now, if you want to own something that's strictly a rental property, in other words, maybe it's in a place where you don't want to use as a second home, maybe it's in downtown and you'd rather have a second home at the beach or a cabin in the woods, no problem. But if you want to own a property that you can also use from time to time, you can do so. However, if you're going to use it more than 2 weeks, can I repeat that?
Yeah, the 2 weeks is really a key part, right? 2 weeks.
That's right.
Because if you use it for more than 2 weeks, it changes things.
That's right. It changes everything. Because 2 weeks you can use it for fun, and anything more than that, unless you're staying there to do, daily intense kind of work on it, we're talking about ripping out walls or putting in things, then it's really the 2 week limitation. Now, if it's strictly an investment property, maybe we should start with that one. It's something that you don't occupy. It's something that you hopefully buy in order so that it'll appreciate. Because when you buy a rental property, what are you risking? There's 3 things. I always tell my clients, I warn them sort of, you are risking your time, your money, and aggravation a little bit for being a landlord, as you know, Jennifer. But it's also your reward for all of this risk is that hopefully one day down the road when you sell the property, it will have appreciated. Okay, so that's that's what we're going for. Now, on this property that you're strictly renting out and you're not using it for yourself, of course you can deduct all of your carrying costs, things that you spend money on, such as the insurance and repairs and condo fees, management fees if you hire a good realtor to manage it for you, especially if it's someplace that you don't live nearby where you don't want to be a long-distance landlord. It's really hard. So all of the carrying costs will be deductible. Plus, of course, you get to deduct what's called depreciation. Now, the property, we're hoping it's not depreciating, but the Internal Revenue will allow you to deduct depreciation each month, each year as you own the property, because that's your benefit for risking your time, your money, and your aggravation. So they'll let you write off over 27 and a half years if it's a residential property. So if it's a condo or a house or a townhouse, or maybe you're even going to own a 1,000 unit apartment building.
Yay!
Yes, something
that's
big.
awesome.
Yes, so we get to depreciate it over the 27 and a half years. It ends up being almost 4% per year. So let's say it's a $400,000 building and $100,000 is just the land value. So the $300,000 that you own of the improvement, you can take off about 9% per year. Okay, so that's good. That's good. Now, every year that you own it, you'll deduct all of the carrying costs. These would be, like I said, the insurance, the condo fees, the mortgage interest, the real estate taxes. But you're also going to get to deduct this $9,000 of depreciation, which really the property hopefully is appreciating. Of course, one day when you sell it, you're going to have to recapture the depreciation. But there's a special tax rate on that of only 25%. So don't let that scare you. Okay, now let's talk about just a second home. Second home, normally what everybody thinks of is a beach property.
A beach property.
Yes.
The place that I go and hang out on the weekends.
Yes, that's the one that's, especially if it's close by, so you can get there on weekends too. Or it could be a place that you go to in Florida, and maybe you spend your winters in Florida. That would be wonderful too. Okay, so here's the deal on that one. You'll always get to deduct up to $1 million limitation on your home and your second home, the mortgage on your second home, and the real estate taxes. And it doesn't matter where your second home is located. You can always deduct the mortgage interest on it up to the $1 million and the real estate taxes. So even if it's located in Ohio or Florida or Monte Carlo or Spain, Mexico, the real estate taxes and mortgage would be deductible. Now, that's it. For owning a second home, you get no other deductions. You don't get to deduct the condo fees or the insurance or anything
Which is a big
else.
difference. I want to stop you there because condo fees are one thing that a lot of people are always asking. You know, the condo fees could be $500 or $1,000 or $2,000. It's a lot of money in a month. And, not to be able to deduct all of those extra expenses. That's the disadvantage of having it as just a second home and never renting it out.
That's right, because it's personal use, just like your own home, you don't get those deductions either. That's right. Now, sometimes with a second home, your condo fee might include a special assessment because they've put in new wiring or new something. And if it's a special assessment for an improvement, you can keep that and hold it. And then when you sell your second home, that can get added to your basis.
Okay.
Because what happens with a second home is there is no exclusion of the gain. So if you bought your second home for $300,000 and you put $20,000 into it, and now you sell it for $400,000, you're going to have an $80,000 gain, which is fully taxable, even though you've owned it for more than 2 years and it's been your second home.
Right.
So gain on a second home is fully taxable. You cannot take that gain and plow it into a new property.
You can't use a 1031.
Correct. We've done it. We'll do a show on those also.
Yeah.
Yeah, so that gain is flat out taxable. And this comes as a big shock to some people when they sell their second home and they realize that, oh my goodness, now they're going to have to pay tax on it. But it's good to have a profit. You never go broke paying tax on a profit. Now, we can have what's mixed use. They call it the Bolton decision. That's a tax decision, which means it can be partially rented out and partially used for business. And then it's a little more complicated.
Partially like a second home and then partially, so like for instance, somebody who might use it for Airbnb.
Yes.
So like maybe a month or two a year, the summer months are the hot months. So for 2 months a year, they use it for Airbnb and they rent it out for short-term rentals, but then the rest of the year they kind of go there on their own. So it's their second home for maybe 10 months of the year, and then 2 months it's rental?
It's rental, yes, you can do that also. And this also happens with a lot of clients who live in the Washington metropolitan area. They'll have a beach house, and what they do is they do rent it out July, August, September, prime months, keep it rented. But then maybe they use it themselves in the spring or the fall, and a lot of times they spend their holidays there. So we do have to divide it up based on how many times it's been available for rent. And you know what? The business use is calculated on when it was available for rent. So you don't have to have used it to make it unavailable for rent.
Nice. Okay. That's very good. That's perfect. So we're back to the original question. So buying a second home, you don't have as many advantages as you have in buying a rental property, but you can also combine the two, which is kind of the best of both worlds.
My favorite thing to do.
Yay! Because then you're really looking at that strategy. So I think it's really important that people look at the different strategies of when they're going to buy their next piece of real estate. What are some of the purposes that they're going to have? And again, like you had said before with the 2-week rule, you need to make sure that all of these time frames are actually adhered to so that you're getting the most amount of tax benefits, like the tax deductions.
Yes. And maybe you have a client who owns several properties. I have clients who own several beach properties, so they can use each of those for 2 weeks.
Oh, that's perfect. Very good. So again, we've been talking to Linda DeMarlar. She's with Tax Masters in Rockville, Maryland. We're talking about the difference between actually owning a second home versus actually buying a property just as an investment property that you rent year-round, that is always rented. So there are different tax benefits for each one, and I highly recommend, again, you build your A-team and that you have somebody like a Linda DeMarlar on your team who's giving you tax advice so that you're actually implementing the right tax strategy for the real estate that you're purchasing. Again, thank you, Linda.
Thank you, Jennifer.
Such a pleasure. I'm Jennifer Hammond. We'll be back with more wonderful tax insights and real estate insights for you.
Thank you for listening to Jennifer Hammond's podcasts. If you liked what you heard, leave a comment or like on iTunes. For more information, visit her website at jenniferhrealty.com.